Horizon Jazz, reaction. This is the history of paper money, working out the Kinks, extra history part 5 by the channel Extra Credits. The first question of paper money is not how much you can print, not even what its value is, but who prints the money. When every bank started to print their own banknotes, it caused confusion and frustration. Enter the central bank. Yeah, I guess we're gonna see how central bank is gonna get formed, and I guess it's gonna tie all the different banks. So yeah. Remember people, if you like my reaction, don't forget to like and subscribe. Check out the reaction today, there's a link in the description. Check out the cards of different places, check out the end cards in here. Let's watch it.
Over the last few episodes, we've seen the intellectual underpinnings of paper money slowly come into place. But having nebulous ideas about why paper money might be good is one thing. Getting people to really believe and trust in it is another matter entirely. And so today, we're gonna tackle the development of the one thing that brought the whole system together. The thing we now use to prevent the very problem John Law ran himself into. Very rarely does humanity find ideas that are simply good. Most of the time, when a revolutionary new idea is introduced, we've got to stumble around in the dark for a bit, figuring out all the terrible ramifications and pitfalls that come with it before we can use it well. Paper money was no different, because when you start printing money, it comes with a lot of questions. Now, you might think that the first question would be, how much money should we print? But actually, before you can even figure out things like how to regulate how much money's being printed, you first have to ask, who's gonna print the money? Now today, this might seem like a bizarre question, as we're all used to there being some central authority in each country or currency block issuing one currency that everybody accepts at face value. But you have to remember that paper money didn't enter the world as part of some top-down system. Instead, it basically started with a bunch of bankers realizing that they could give people receipts for gold and silver instead of actually giving customers their gold and silver back. Which means that one by one, every bank basically started printing their own banknotes.
Yeah, okay, I understand what the question is here. Basically, every local banks, right, start to give what IOUs, the money basically. Those IOUs was worth what the bank was worth at the time. But how do you know what paper is worth what bank is worth what? It could create confusion, like if you go in different cities and things, right? I mean, you could trade it like that, but you have to figure it out, like this note is worth what. So, at the local stage, it was fine, but it started to, you travel from place to place, it probably became harder. So that's why they needed central bank at that point.
And that is a mess to deal with. I mean, if you've ever had to go overseas and deal with exchanging money, you've gotten just a tiny fraction of an idea of what a hassle this would have been. But it gets worse. Imagine having a few hundred different banks issuing notes in your own country. Now imagine a world where our modern international currency exchange that makes it easy for banks to trade money doesn't exist. And then imagine having to deal with all of this just to shop in the next town over. This is basically the scenario you end up with. You deposit $10 worth of gold in your local village bank. They hand you back $10 worth of their shiny, bank-specific banknotes. Now you go off to the big city to spend your money, but when you bring out your money to spend it on something there, the big city merchant might simply not take it. Or, more likely, they'll pull out some big chart and say to you, well, let's see. Your bank is pretty far away, so if we, or more likely our bank, ever wanted to redeem these banknotes of yours, we'd have to travel all the way to your tiny podunk village. So, since that's going to be such an expensive hassle for us to do, we are only going to take your banknotes at 75% value. Now, of course, you would probably grumble a bit over this, but then the merchant would say, wait, hang on, I'm not done. It says here that your bank only has one branch? That's an issue. It means we're gonna have to redeem these notes as soon as possible because your tiny bank might go belly up at any time.
Yes, I was gonna say that. It's not just that, bank is at the far distances, that I don't even know if I can trust your bank. What if they don't have the gold that they're claiming? I mean, what if they just, give out notes way too much? Something like that. I mean, trusting some bank is also an issue. And like he said, what if the bank goes, under immediately?
Would render these banknotes you just gave me worthless. That additional risk and the inconvenience forces me to accept these bills at another 25% off face value. And so, your $10 that you deposited in your bank would only have $5 worth of purchasing power in a neighboring city, leaving you probably a bit less than jazzed about this whole paper money thing. So clearly, every country needed a unified currency that everyone could believe in. But this also had to evolve sort of organically, and it ended up happening in a similar way in most countries, because almost all of the problems we're gonna see with the move to paper money are solved in nearly every country with one great innovation: the central bank. But central banks didn't always solve all of the functions they do today, and in fact, most weren't established to solve any of them at all. Truth
Yes, central banks, I guess it's pretty common sense when you think about it. Like, okay, that bank is way far away. I don't trust that bank. I mean, you need someone in the middle who you can trust and who can assure you that I take responsibility for all the other banks and things like that. So basically, the one thing that you can trust so that all nodes have power. Central bank is essential for that.
truth is, calling a central bank a singular big innovation would be a lie. They were really more like a patch server and a hotfix machine for paper money. So let's talk about the story of the Bank of England, because it was really the first institution that we would call a central bank, and many early central banks share a similar tale. The year is 1694. The government desperately needs a way to service its debts. The 17th and the 18th centuries would be times of unbelievably costly wars. For the first time, troops had to be deployed and supplied across the globe. Navies had to be maintained in every ocean. Powder and shells were expended on an unprecedented scale. This drove most major nations of Europe to the brink of financial collapse. To some, the answer was clear: establish a bank to service the national debt. So, after much debate, the Bank of England came to be. This is a powerful thing, because having the government do all of its banking with your bank makes your bank pretty secure. And
that joke is so good. So they first thought, ask Jesus for bread and fish. They're like, okay, I guess we're not getting that. All right, let's think about something else. Let's think about it. Oh, how about a central bank?
means that that bank's gonna need to have branches, or at least banks that they work closely with all over the place. And because of this security, people started to value Bank of England banknotes over most of the other ones out there. At times, people would even pay a premium for them, offering 1.1 or 1.2 pounds per 1 pound note, simply because they were reliable and universally accepted. But the Bank of England note really wouldn't become the official banknote of the country until 1844, the middle of the 19th century. With the Bank Charter Act of 1844, no new bank would be granted the right to print banknotes, and every time a bank was bought, it would have to remove its notes from circulation, meaning that eventually the Bank of England banknote would be the only paper money in the land. But even with this system, it wasn't until 1921, less than 100 years ago, that the last non-Bank of England bank in the country stopped printing their own banknotes. And in Scotland and Ireland, there are still to this day a few banks that retain their ancient right to print pound sterling notes. So this system of having one unified currency that we think of—
Wait a minute, so there are some local banks like that who are printing notes like that, who are right now in the circulation? In today's culture, in today's economy, I feel like that would be a problem.
as being money, we take it for granted now, but it really isn't that old. In fact, in the United States, non-Federal Reserve banknotes were being issued as late as 1935. But even with this issue resolved, the lack of a centralized currency wasn't the only problem we were going to have to figure out with these new banknotes. There was also the problem of bank runs. With the invention of the banknote, modern fractional reserve banking really came into its own. Fractional reserve banking is where the bank lends out more than it can actually pay for with the money it has on hand, based on the idea that not everybody's going to try to collect at once. So, for example, let's say that you deposit $100 in gold at your bank, and the bank is required to keep a 10% fractional reserve. That means that when you deposited that $100 in gold, you enabled your bank to lend out an additional $1,000 in banknotes. This system is a great thing because it means that the money supply can expand far past the amount of gold or silver in an economy, and can meet the needs of a growing economic base, which is the very problem we were trying to solve with this whole paper money thing in the first place. But it does have one problem. What happens if everybody does try to get their money out of the bank at the same time? Well, if people believe that a bank won't be able to repay them, whether it's because they've issued too many banknotes or simply because they've made too many bad loans, those people start flocking to the bank to get their money out of there. This, of course, leaves the bank unable to pay anybody because they only keep a fraction of what they need to pay everyone on hand at any given time. So the bank collapses, and everybody loses. Anyone with money left in the bank is simply wiped out. And if this starts happening on a broad scale, it creates another problem. People stop depositing money in banks at all and instead start hoarding it because they're afraid that the banks are going to go bust. Meanwhile, the banks are trying to hoard up as much real money, gold, silver, and central bank notes as they can, so that they can somehow pay all of the people rushing the bank to withdraw their accounts without going bust. This ultimately means that a lot of money is just sucked out of the economy. It just stops circulating, and we're back to our original problem of literally having too little money to make the economy run. This happened in England throughout the 19th century. But here again, the central bank patch was applied. By having a central bank serve as a lender of last resort, meaning a bank that could lend real capital to other banks, banks that were in good shape but didn't have the funds on.
Ooh, yeah, that is something, right? I mean, before that was a real issue. Like local banks basically gave away way too much money. I mean, obviously it makes sense. It's like, circulating more money than the place actually has. That's it's kind of type of loan type thing, right? Because eventually they will make money back. So basically, but if everybody just runs back and just try to collect the money, obviously bank doesn't have it because bank gave out way too much money than the bank actually had. But now if somebody does that, central bank's just like, okay, I got you because basically you're under my protection, and obviously I'm central bank. Entire country's banks are under me, so I would have enough money to cover at least one bank. So there is an insurance for every bank, so banks would not go up now. Damn, that is something I didn't thought of that.
On hand to withstand a panic where everybody tried to withdraw their money at once could survive, and the money supply for the nation wouldn't dry up. Over the last 100 years, we have found dozens of other little ways that the central bank can be used to hotfix problems resulting from our ability to print money, and we're certainly not done yet. There is incredible power in having one bank that basically can't fail unless the government does, whose function is much more about keeping an economy strong and stable than about making a profit. Because so long as the government is doing well, so is that central bank. And this has helped fuel the growth of a world no longer bound by the amount of gold and silver that's being passed around. But there's one more step to go before we get to the world we live in today, where currency is divorced from any real value except the value we give it, where money works because we believe it works. And that step is abandoning the gold standard. So join us next time as we wrap up the history.
Yeah, first of all, like I've said in the previous videos, paper money, obviously you can't just give out as much as paper money out, even if you don't have gold or some kind of a real power behind it, and just thinking that's money, because that's just paper in the end. What does that even mean? You can't just print unlimited money and just call your country rich. No. So first of all, gold, right? Like I said, gold has money because gold implies that if you have gold, then you did some kind of service or gave some goods to somebody. That's why you have gold there. So, if you give somebody else a gold, that person realizes that whatever our service gave to you, you gave me gold, and whatever, deed you did, now it passed on to me. So it's just a recognizable way of saying that, you did something. Now gold transfer into money, like if you have a certain amount of gold and now you gave away paper money for that, every bank does that, and now you gave away more of that, that's just mean bank is basically giving away more than bank has. But that's fine because it's like a temporary loan type of thing, right? Eventually the country economy basically will make it back by trading and something like that. But as far as the bank doesn't give out too much, because that will basically break things up. People will suddenly realize that there are way too much money than it's actually worth. So everybody would just run back to the bank, and it would create a bubble. Basically, it would make the bank collapse. So obviously now central banks can support every single local bank, so they wouldn't collapse like that. They could give away the money, but there is a limit to how much money banks can give out than the gold things they actually have. Nowadays, like he said in the next video, we'll see the gold is removed from the equation. Money has value because we say it's value, but it's not just that. It's based on how much trading a particular country does, right? How much value every country has. Based on that, the money has value. Otherwise, if you print more money at the world stage, that particular currency's value goes down. So you can't just print money left and right and say that has value because we say that value. No, that has value because wherever that money is from, that particular country can do certain things, provide certain services, provide certain type of trading, and because of that money has value. You can print a bit in excess, basically more money than you're worth, but that's just like a temporary thing. Eventually, by trading, by giving certain services, you will have to make the money back. So yeah. Alright people, that was the history of paper money, working out the Kinks for the channel Extra Credits. If you like my reaction, don't forget to like and subscribe. Check out the Bricks Andy. There's a link in the description. Check out the cards, we'll place, check out the cards, and I'll see you next time.